British Prime Minister Liz Truss is reversing a controversial plan that would have reduced taxes on some of Britain's highest earners.
The move comes after markets reacted badly to the proposal to scrap the 45% tax rate. It was part of a package of measures that she claimed would jumpstart the UK's sluggish economy. Instead, it sent the pound crashing to historic lows against the dollar and forced an intervention from the Bank of England to defend the currency.
Right. So joining us now is Javier David. He's the managing editor of business and markets for Axios and joins us in the studio. Good to see you.
Good morning.
All right. So Anne-Marie sort of teased it, but how did the markets respond to the PM's economic plan?
It was basically something that you would see associated with an emerging market. Investors basically hit the sell button on just about everything. The pound, bonds, stocks, etc. It was a widespread sell-off. It was basically a gigantic no confidence vote in the government. They didn't like this plan. I think in an inflationary environment, the last thing you want is more stimulus, and tax cuts are stimulative. Whatever you think about cutting taxes for the rich or cutting taxes in general, anything that puts more money in people's pockets at this particular juncture when we're struggling with high rates, high rates of inflation, which is indicative of high demand. The bottom line is it's just more stimulus and more reason for inflation and prices to rise.
And then just when I was going to book my vacation to the UK because the pound had tumbled, I think it's back up again.
It's come back,
But you still have an advantage,
You
right?
still have, very much so. I mean, we're still sort of near those record lows. It's come off substantially, but the British pound used to trade at 150, 175 for the dollar, and now we're at, I think, 110 and change, 112.
Okay, that's still a deal compared to. Okay, so we're going to switch gears. We're like this today. Lots to talk about. Okay, it's been a turbulent few months for the markets here in the United States. Should people be worried about their 401ks?
The one piece of advice that I have for people watching the 401ks, don't.
Thank you.
Unless you're retiring tomorrow.
I say all the time.
So
unless you're
hard,
retiring next week, it's very tempting. I agree.
They make it so easy with all these
I haven't
apps.
looked at mine in months. The minute
Javier,
the market
that's
starts
what I
crashing,
say to Anne-Marie. I'm just like, last time, all my statements, they pile up in my desk. And I never even open them. And even when my financial advisor, who's like a childhood friend, he'll call me and he'll be like, dude, we got to talk about, I'm like, what?
Look, even if you're retiring in the short term, you're still going to be invested in the market to some degree. So you'll have money. And the markets have a tendency of short-term volatility scares everybody. And everyone immediately, their first impulse is like, oh, what's going on in my 401k? Let me see what, oh my God, I'm down 25% year to date. It's paper wealth. It's not real in a sense. It is real, but it's not real. And the bottom line, I think, for most people, don't feel or feed that impulse to sort of look, because you'll be upset. And you don't need to be. Again, unless you're retiring in the immediate term, and I mean immediate term, I'm saying like within the next week or so, and even still, you'll still be invested in the market, so it'll come back up.
Yeah, it's like Javier's been watching me. Like, you see how he did his thumbs? Like, that's my thumb movement. I'm like, oh my gosh.
That's exactly what I do. I have to stop myself. Like, you know what? Not doing it.
But let's use that example, Javier, that you used as we get a little closer to the holidays. People. My nephew, for example, started college this fall, and so his parents would have been putting money aside for this moment for years. And given the volatility right now, and you're thinking about tuition payments, for example, or you're thinking about, let's say you were going to buy a house. Like, my parents are actually in the middle. They just sold the house that I grew up in, and they're buying a new place. So for people in a situation like that, where they do need cash and they've been invested in the market, and they've seen this volatility, what's the advice there?
The advice is you're going to still be in the markets. Take what you think you'll need, and it's hard because, especially if you need the money right away, you're drawing it down. There's this fear of, oh my God, like if I had done this a few months ago, I'd have been better off. But now, obviously, you're a creature of the market. You can't control the volatility, but you can sort of calibrate your plans or calibrate the spending accordingly. So in a time like this, a lot of investors are it's a good time to sort of look at where you are and where you're positioned in the market. If maybe your things are too aggressive, maybe shift a little bit more over to sort of cash or government bonds. Well, government bonds have been really turbulent as well.
Have they?
Oh yeah. We've had a real historic route.
The market goes down, bond prices go up.
We usually go up, but this time, because inflation fears and sort of the pace of the Federal Reserve and the Bank of England and all of these central banks around the world hiking rates, it's created a tremendous amount of volatility. There's almost fears of an interest rate shock. And one of the sort of dirty little secrets about what happened in the UK is some of the pensions there sort of got margin called, which is because they're invested heavily in government debt, and now all of a sudden bond yields start shooting higher. They've got to find a way to scramble to cover those costs.
Wow.
A lot of volatility, and it's not ending anytime soon, according to a lot of analysts that we've spoken to.
Javier David? Before it gets better.
Yeah, for sure. Always good to have you in studio, man. Thank you very much for coming by.
Thanks for having me.